So, welcome back to the session once again. Let's continue from where we discontinued during our last session. We were discussing income approach and related methods of business valuation. We started discussing with the income capitalization method and discounted cash flow method. After that, under the income capitalization method, we discussed three different models, and those were single period capitalization model, multi period constant income capitalization model, multi period constant growth in income model. Now, this multi period constant growth in income model is also known as Gordon Growth Model, GGM, Gordon Growth Model. Then we looked at the methods or models available under the discounted cash flow method, and we understood two of the models or two situations where we do the discounted cash flow or we use the discounted cash flow method. And number one is method for valuation when an entity has a finite life and when entity has a infinite life. And then we discussed different illustrations and understood with the help of different illustrations as to how to calculate the valuation of different companies under different situations. And the last thing that we did and we understood was two-stage discounting model for valuation of an entity with infinite life. We understood very clearly the reason as to why do we have to use two-stage discounting model, and that is because companies have infinite life. Since the companies have infinite life, obviously you cannot calculate the projected cash flow for infinity, and since we cannot calculate projected cash flow for infinity, obviously we cannot calculate present value of the future cash flows in a situation where we have infinite life. So how do we resolve this conflict? We resolve this conflict or this situation by using two-stage discounting model. And in case of two-stage discounting model, we understood to break the period life of the company into two parts. One is known as explicit forecast period, and the second is known as terminal period or the continuing period. So both are the names for the same thing. And how do we do the evaluation? So we calculate the projected cash flow for both the periods, explicit forecast period as well as the terminal period, and find out present value of both these cash flows, and find out the cash flows for both these periods and discount them. So this is how we were discussing in the context when we met last time. So let's continue our discussion from here. And we also did a case study of computing value of a business using the two-stage discounting model. One thing that I would like to refresh here once again, and that is how to find out the free cash flows, how to find out the free cash flows.